we often talk about power law distributions, Pareto distributions, and so forth. I mean, what that, ultimately means is that a very small percentage your portfolio is going to drive a vastly disproportionate amount of your return. It also means that the vast majority of your portfolio is going to drive no return whatsoever. There is a scientific theory to that. I mean, distributions are a fascinating thing, but 99% of modern finance is based upon a normal distribution. So everyone applies normal financial theories without really understanding that your core assumption that you made is wrong. When we talk about option pricing theories or things that, predicated the credit collapse in the 2008 and so forth, these were actually, on some senses, just failures of really kind of adequately understanding. This is very interesting when you're driving the venture space. Like, you really got to understand those dynamics, model it out, understand how to do it. I mean, like, there is other things of looking at the macro impact.
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have the one and only Benjamin Bryant, an early stage investor and technologist with one of the most eclectic resumes in venture, from trading desk to Pebble Tech, from leading visual effects systems at Warner Brothers Animation to backing deep tech and bio companies. He brings a rare mix of engineering, product, and investor acumen. His portfolio spans over 480 companies, a lot of big names that you've probably heard, and he's known for jumping in early with conviction. We're so thrilled to have him today. Thanks for coming on.
Thanks, Brian. Glad to be here.
So you've gone from this visual effects to head of tech at a quant trading firm, then to Pebble, and angel investing. What ties all those threads together?
If a lot is like, these have had two qualities: me saying yes to people approaching me with random ideas, and I think focusing on, really what has excited me at any given point in time. I mean, it came out of undergraduate into, when someone says, do you want to go work on a Looney Tunes movie? It's, for a computer engineer / film major, it's not the opportunity that exactly comes along, and packed everything in the back of the car and drove out to Los Angeles pretty much the next day. That led to that. Also, I mean, coincidentally, went from there to actually working some of the first 3D printers. It's not on the wider resume. It's just from there. And then, I think the hedge fund is the non sequitur. Someone said, do you want to come work for a hedge fund? And I said, I don't know what that is, but sure.
That's amazing. Yeah. They need a lot of computer engineers like you. And then, there's this famous story of Pebble and the smartwatch wars. How does that influence how you invest today?
Let's see here. So, I mean, to, go a little back there, I had an early career deep in finance. So, high finance, built some of the first high frequency trading systems, was foreign exchange trader in London City, and actually spent some corporate finance time in Dubai. So I had a very, want to say formal traditional career, and then came back to the US, what would be, I don't know, shortly after the major credit crash. And, it's like, all right, what do I want to do? And so I started a music marketing platform called Earbits. That is what got me into YC, led me to become good friends with Eric. Then we, started helping out and had our big success with Pebble on the initial crowdfunding Kickstarter campaign. So, I think it's really kind of two things. I mean, we talk about the smartwatch wars, but I think the juxtaposition from we had a music marketing platform that the unit economics worked, but it just never realistically was going to take off. We were too tied to we're too tied to the musician around there. And if you, at the end of the day, the music industry is about fame. And so you need to get big for the business to make sense. At that time, I think it was Dalton who famously got up on a soapbox and said, no one should ever invest in a music startup. So that pretty much killed our, funding opportunities there. But then moving from Pebble, which I think is important to note that, at the start, we were a hardware company. Similarly, investors were not of interest in that product. Now, unlike Earbits, what happened is we launched a campaign on this nascent platform at the time called Kickstarter, woke up the next day to $1 million in the bank account, and then it was just, off to the races. I mean, pretty much every three days, the press cycles would drive another million, and we did a $10 million campaign, which was completely unheard of at that point in time. So, the joke off of that is always like, oh, this is what traction feels like. But, that really is actually the literal takeaway. It's like you suddenly understand what it is like to have a product that is the polar opposite, that is in demand, that does have product market fit. And, it was very nice for a period of time where we had the headwinds. Like, it was not trying to figure out how to sell the product, how to find the customers to buy it, but just how to execute on the product. And that was very refreshing. Like, it's always a great time period that for companies. That doesn't last forever. Now this is getting into the perceived smartwatch wars. For a while, like, there was no competition. We would reach a certain ceiling and, just not able to drive any additional sales. And what's very interesting is when you are on the venture track record, it's great. You're signing up for, 2, 3x, 4x growth on an annualized basis. That when you're doing an emerging product, like, we had a great revenue. It's just like, it's not sustainable. And so, smartwatch wars is interesting. Like, the biggest thing Samsung did for us with the Galaxy Gear was suddenly when I'd fly back to LA and talking to my Uber driver going home, he actually knew what a smartwatch was. I wasn't kind of explaining this base level thing to them. And that really kind of made it more broadly aware outside of, like, you go on the Caltrain and literally everyone's wearing a Pebble. Like, it was not the same.
Yeah, my wife and I had one back in the day, probably 2014, something like that.
So, it's really interesting. I mean, then, Apple comes down. I mean, it drove more sales, but you eventually, there is, one winner, and Apple cracked, I think, the big nut in this space is that they realized, like, look, this is ultimately just a watch. Sell it like watches have always been sold, as fashion products and so forth, that has, technological features or health features on here. And so what I'm taking is, like, it is really a lot about, like, just the journey of a business. Success today does not predicate success tomorrow. Every company is going to have challenges, at various points that are going to continually evolve over time. Like, the model I have is you spend a lot of time trying to figure out how to get anything off the ground. Suddenly you get it off the ground, you go up, but then you hit a plateau at some point in time. And,
a step change, like there's a whole new set of problems.
I mean, I use the metaphor often of, like, you're mining for silver or so forth. Like, you will spend all this exploratory process to find a vein of silver. Once you found it, you will mine it. But once you have depleted that store of it, you've got to move on to the next thing. And, you'll try to locate where there are plentiful, rich deposits of minerals and so forth. We actually do have a company that does that with AI.
Oh, I think I know which one you're talking about out of YC. Yeah. Really interesting founder.
That is really, how it is, until eventually you build the brand, you build the broader reputation, you build the distribution channels and so forth, that you are actually able to, move. You have a control system that now this is not a hyper growth business. This is a growth business, and you're able to, chart the path forward till, eventually you're either acquired or, go public. So I think, to pull out one of the things, myriads of operational side of, things that come on for, like, just having that experience of going from 0 to, 200 miles an hour, and all of the complexities that come along with that. I remember we're hiring like 4 people a week at one point in time. Like, there's a strain that is put on a business that I don't think you can't read about. You can't, understand. Hiring executives, it is not a science or so forth. Like, it really is a bit of an art. My biggest learning and takeaway from that, you hire an executive to execute on a predefined plan. They are not a founder that's going to be creative, going to think out the box. Like, you are pulling a tool off the shelf that you're applying to your businesses. You can learn a lot from them and so forth, but they can also do a tremendous amount of damage to your business. Those are things that I can tell you or another founder or so forth, but you don't want to say material, like, you don't intrinsically understand it until you have been through, that period of time. So, translating that into what I do now, like, it's just a very, to have been at one of those companies, be it, a Facebook and then Uber, whatever it was at that point in time that has gone through there, it forms you. And, for me, coming at basically from inception to kind of the peak, it really, you see it all. And you also understand, like, when there's mistakes or you don't think things can get much worse, you don't actually really know how worse they, like, things just keep happening and keep happening. It's like the waves just keep hitting you, but you all get through it. And it, builds a really good perspective of perseverance and, what ultimately I think it takes to, grow a business to the level of what it is. And, if you don't have, that kind of forge to build. Like, you understand the mechanics, but you don't really understand what it takes. And I think as I look, a lot of, we'll call them seasoned founders or so forth, you do understand, like, just on a certain level, that like there's a level, like an acknowledgement of respect, like, oh, you truly get,
On those second and third time founders, you're kind of,
like, until you have had kids, you don't actually understand what it's like to have kids. So
I tell people it's the worst possible thing you could do, but also the best possible thing you could do. Probably like starting a startup.
Yeah.
It's the worst possible thing you could do.
Startup is a remarkably good preparation for parenthood.
And I see the surfboard back there. So like the waves crashing. Are you a regular surfer?
Not a regular surfer these days, but I mean, it's kind of the requisite activity when you move out to Los Angeles as a 20-something to take up surfing. Which my first day ever surfing turned out to be like the largest swell that had hit LA that year, and so it kind of
how big were the sets?
I don't particularly
probably
recall.
14 to 18, 18 to 20.
I was in a washing machine like 24/7. It's like you get caught between the break and the shore, and you just have to, like, your only actual way out is to paddle despite having no energy whatsoever.
Yeah, that's amazing. What an amazing story. And there's like so much we could tug on there. How has that changed your perspective on product, and from, as you went from a builder to a backer?
Product, I think, there's a couple different aspects. Like, product is an interesting idea, but when you are a backer, ultimately you are assessing the business and the investment opportunity. And I think from my perspective, again, like, I come from a very traditional finance background. Our LPs are very traditional finance people. I wouldn't say our analysis, but like, there is a vein of perspective of how I look at the stuff that is really, what is the investment opportunity? What's the growth potential? And it's very, how you do that in the venture space, particularly early venture space, is very different than, public markets on many different levels. But, so, when you look at product and so forth, it is an aspect, of that. It's actually not, I often think about this. You have, the opportunity that you intend to capture, and then you have the risks that are associated with that. So very, basic expected value calculation on, product actually falls in the risk category. It's a de-risking aspect of it. And so, it is to some degree secondary to, what actually matters. Like, it is what's going to unlock the potential. It's going to unlock the growth. There is ways to do it right. There is ways to do it wrong. But I think, what has shifted in there is kind of, looking at the place and how product fits inside there. If we talk about, in the background of Pebble and stuff, like, when you have banged your head up against trying to, find, we'll call it product market fit, but actually much more, I'd say, trying to find, the next growth channel. We found, if Pebble's secret sauce, we found that, hey, actually developers and makers and the builders and the people that hang out in the Hacker News crowd is a very large and viable, market. So you can just sell to them. But, as you try to branch out of, that community or so forth, you start to have to change how you craft your messaging, your value proposition, how you fit the product. To some degree,
it's like they're crossing the chasm, right? You got your early adopters.
It's crossing the chasm. Yes, ultimately in there, like, there's a lot of holes in the, in the crossing the chasm side of things. It's multiple chasms, first of all, but having banged your head against the wall so many times to just, try to figure out, it gives you a little bit of perspective, both of how much effort it takes to craft it, as well as where the shortcuts are. And, I think maybe as you talk to, like, all right, investing in individuals, advising individuals, a little bit of sense of, like, those who have the right, acumen for it. There's a fine line between, a little bit of stubbornness, a little bit of flexibility, a little bit of, lack of self-awareness, but so forth, that, really tailors, the right people for, product discovery. If, like, Eric is got a spidey sense when it comes to consumer electronic devices. It's just time and time again, he knows what his market wants. He's not going to be able to sell to my grandmother in, Ann Arbor, Michigan, or wherever it may be, but for, the audience and crowd we knew there, like he gets it. And like you will see patterns across different founders, different verticals. It's always, changes a little bit, but, you kind of, you have a sense of those who've got it, you have a sense of those who can achieve it, and you have a sense of like those who are just, not realistically going to get it without a lot of, being forced through the funnel a while and finally realizing, oh, this is, how it works.
So after nearly 500 investments, which is just incredible, where do you come down on the art versus science of investing?
Art versus,
Especially in early stage.
Yeah, I mean, I think there is a science to it. It is finance, there's patterns, there's data, there's things you can go back and look at. And that is useful, but what it gives you is a model, a framework, kind of a set of operating bounds to then make decisions with inside. We often talk about power law distributions, Pareto distributions, and so forth. I mean, what that, ultimately means is that a very small percentage your portfolio is going to drive a vastly disproportionate amount of your return. It also means that a vast part of your portfolio is going to drive no return whatsoever. There is a scientific theory to that. I mean, distributions are a fascinating thing. 99% of modern finance is based upon a normal distribution. So everyone applies normal financial theories without really understanding that your core assumption that you made is wrong. When we talk about option pricing theories or things that, predicated the credit collapse in the, 2008 and so forth, these were actually, on some senses, just failures of really kind of adequately understanding. I mean, Nissan Taleb writes a ton about, distributions and so forth.
Black Swan and Fooled by Randomness. Great books.
So, this is very interesting when you're driving the venture space. Like, you really got to understand those dynamics, model it out, understand how to do it. I mean, like, there is other things of looking at the macro impact. Like, you want to know what drives valuations and exits? It's interest rates. It's inversely correlated. And, it is, both at a just broad systematic level and on like the individual company level. Like, there are, very rational reasons to make certain decisions at that point in time, depending on where interest rates are and how much money is flowing in, flowing out of companies. So that's all, the science side of it. But that's, to me, is what's laying the playing field. Now, if you're going to ask me, what is company X going to be doing in 10 years? I gotta be honest, I have no fucking clue. Like, you are, I mean, what's the Steve Blank view of stuff? Like, your startup is a search function to find a scalable business. And again, touching back to, maybe I'm ascribing that to him, or who knows, but
I think that's what he said. Yeah, something like that. You are a search you're a search function, right?
Yeah. Which, to be honest, is a search function for tomorrow. It's going to be a slightly different search function, the next 2 years down the road.
And that's what you were describing with the step changes, the step functions of like, okay, you got the first million and then you got the first 10, and now you're facing a new search function problem.
Yeah. I mean, it is. And so, you are fooling yourself if today you go in and you're making an assessment of this company that you have any grounds by which to realistically forecast where that company is going. At the same time, look at the incentives of individuals raising funds and so forth. Like, if I come in and say, I don't know what's going on here, who's realistically going to say, oh, well, then I want to give him,
here's $100 million. Go for it.
And so, which, I mean, to the contrary, like, we actually, I run the opposite direction, and we have people that understand, the nature of it. So, I do think it's very feasible, but like, this creates a whole dynamic of people that are trying to, are basically pretending that they actually know how to forecast the future. If you really bake down to it, you have access to a particular company. There's a small number of companies that really are able to just, investors that are able to make, a company. I mean, a large multi-stage fund and Andreessen Horowitz, they're going to narrow it in there. But I mean, simply their stamp of approval is going to give, basically their, line of capital and connections are going to, make company, or you really just get lucky. And I think you got to think getting lucky in this space is not actually a problem, because if you look at the distribution and you simply spread your bets
Right.
over a particular period, section of stuff, it actually turns out to be a very well priced product. Your reward for the risk that you're taking on, is, in alignment with where it should be. And so, it's a different way of having to look at it. Like, no individual company on one level actually matters. They do. There is, I can quantitatively tell you that, like, there is signal and stuff and things that we can add in there. But, if you started from a position from random and you went into a batch like YC, which, now think about what it's doing. YC is picking companies, but they've also built a reputation, a funnel, such that it's self-selecting. They get to look the best of the best, and they're able to do it at such volume, that they are able to surface out there. And when you do find a winner, or someone that's got, I want to say, above average prospects and has demonstrated progress, you now have the mechanism to drive more capital in there to accelerate that growth. And at some point in time, you shift over from the search function to the, I found something and let's figure out how we can, trade it. And, it's consequently, I mean, I think if you look at the past year or two, the number of, $1 billion plus or $5 billion companies that list, 78, which is actually more than that, out of YC from seed and so forth, almost an order of magnitude more than literally any other investor out there, while the secondary and tertiary funds that are in there are either accelerators or are individuals that basically draw their primary pool of companies out of Y Combinator. You can see at a macro level that actually this randomness play does pull out. And again, it's not totally random. I did a study from our earliest funds, like we are about 15, 16% better than pure random in what, we do in terms of, picking companies, whether that's we're adding value, we're simply filtering out, others down there. But that's actually, a remarkably good. And that's actually, if
That's
you
a lot
kind
of
of look
signal.
at, you look at the pool of stuff. I mean, I remember back in, traders, like, if you could be right 50.1% of the time in a public market trading system, you'd be one of the richest people on earth, consistently. And so, in this particular vein, where we're not able to actually cycle through companies so fast, like, that is, around about the upper bar typically that, company that individuals are able to do with any statistical significance. You will get, those people that invested in 4 companies and turns out one of them,
That's
blew up.
extremely
But,
lucky.
you've got, 50, 60 companies, like you're all going to trend towards some particular
average.
mean. Yeah. And so,
I
we've
love
really
that. And
digressed.
you're describing so eloquently what I also believe, but I would put it in different terms. I think if you look at investing, and you worked in finance, I worked on Wall Street, CFA, all that stuff.
Yeah.
But when I became an angel investor, I was like, okay, well, mathematically, what's the proper diversification strategy here in this asset class? I was like, what's the efficient frontier? Like how many
Yeah.
investments do I need to make to guarantee I hit the average? And the average for venture is like a 25% IRR industry wide. But the standard deviation around that mean is enormous. It's like a 30% standard deviation. And so you got some VCs just crushing it, and some VCs like losing money. I was like, what is going on here? And I think, we're birds of a feather here, which is they're investing in 15 or 20 companies a fund. Like, if it's just mathematically not enough to hit an outlier.
Yeah. So, I think perhaps we've taken that to a bit of an extreme. But, there's a couple of, there's some interesting, like, yes, I've certainly taken to a extreme because, from a modeling systems perspective, honestly, like, you're missing a winner is far more relevant to your portfolio. Like, I had the second, third, and fifth most valuable companies out of the first batch that I invested into. All right. Tremendously good fund. Had I invested in the top company, the fund would be 3x, larger in terms of value. We managed to, we do very well. We're well up in, I think we're in like the 95th percentile in terms of, seed funds at that point in time, for that vintage. But it is, just puts you in perspective. It's like, there's always a bigger fish to catch. And so, I think, our perspective is, we really do look at as many viable, companies on there. And, I think also from a different side is, you know, there is, there's systematic risk within inside the system, and there's idiosyncratic risk within inside the system. And so you can look at, we talk about like orthogonal vectors of risk, or, different things like geographically, companies are exposed to different levels of risk. So if you diversify geographically within inside a department, you're going to remove some of the kind of risks inherent in there and actually produce, we talked about your efficiency curve and so forth, like, produce ultimately a profile that is able to return a better expected value at a lower unit of risk than you would have otherwise been able to get.
Right.
Sectors, you could say, founder age or so forth, like just a lot of different, variables going into it. Like you can edge up a little bit simply by constructing your portfolio in such a way that you make sure you get calculated exposures to those different things. And, I look back at, some of our companies, like, when everyone else had gone off of Latin America, we're still pumping money into those companies. What happens? We're getting in at lower valuations, and the companies are still doing just as good out there. And so, they're not the top performing the company, but they're, as a block, a very high performing group within inside the portfolio. So, there's like portfolio construction applies to venture. There's a lot of really interesting, it's not basic. It's like, it's finance 201. But it, it does make sense. And I think we've kind of been able to show that, like, it plays out. And I think the probably third thing about going broad and so forth is, people kind of don't recognize the network effect that comes out of having a network effect, the educational effect, and so forth. It's like, I see at an intimate level everything that is going on the ground. While company A, I may not be able to drive value with, I don't have the company on there. There's going to be myriads of companies within inside the portfolio that one of our LPs or one of our connections or so forth, like, is going to be able to make a meaningful connection to that. And so, if I had 20 companies, all right, I'd be able to do that a little bit, and I'd probably be able to put more effort into an individual company. But like a lot of what, we're doing now that we've moved to 4 batches a year and really are kind of like growing what we do as a business is, seeking a way to drive value to, the portfolio companies simply by the sheer, volume that we're able to do. And that's something that, with AI systems and stuff now, like, it would be a huge manual process traditionally. Now I can get much of the legwork, automated in a particular sort of ways. I don't know. It's been, a very interesting shift that I think has, come as a result of, what was ultimately a well thought out quantitative strategy to now, you basically saw a whole different level of benefits that come out of the volume, that we move. Simply, from our perspective, like, because we have so many companies out there, if reputation is one of the key things to getting in a deal, where do you go to, you're looking on Google or Yelp, what restaurant do you choose? The 5-star one with 12 reviews or the, 4.9 with, 500 reviews?
Or
like
1,000
it's very,
reviews. Exactly. Yeah.
it really, that the volume signals something, to people. And like, it does play out. Like, we, as long as we talk to a company early, like, it's been a while since we've not been able to get allocation in those particular businesses. And, in the YC space, that is what matters. Like, it's not standard venture environment. Like, you have this window, it can be a little as 24 hours that, if you've got to know the person there, you've got to have the meeting, you've got to be able to make a decision, close and quickly. You've got to have the check size. It's not going to make it a difficult decision for you. And then you get the allocation, with a small elite group of investors. And if you, didn't get that call, you divvied on it, you did something like that, they're not going to take you on. You're not that they're not going to, just you miss the opportunity. Right. And that's not all of YC. A good percentage go on, and we've had, some of our, I think, most profitable positions, like, for particular batches, like, we've invested literally a month plus out of demo day, it doesn't have a correlation to success, but it's a segment that you want to make sure you get, exposure to.
Yeah, dig into that. I just wrote an article on that, and it cited some research on this about. I think it even cited you and definitely Rebel Fund's research on YC, which is that the hottest deals don't that fill up before demo day don't necessarily correlate to success.
Yeah. So I mean, they actually don't correlate, but I think there's a difference. There is hot deals, which I think are widely assumption. Like you will have a section of companies that will say, okay, cool, we're going to make our decision at the end of the week, and we are going to solicit everyone that want to. Well, what will happen? I mean, I'm actually not going to name names, but you will, like a meme coin, like something else here, like the FOMO of missing out on a deal is powerful in terms of decision, or there's certain signaling about it that particular investors, so forth, coming in, and because you really actually are in a situation where you don't really have grounds to make a deeply reasoned decision about a company, like and often, like, there are many companies people just don't actually have any wherewithal making any I mean, the number of investors that I see that have no engineering experience are talking to a company that is deeply technical. And some founders very much use that to their advantage, but I want to say people will use these cliff notes, short indicator proxies for any actual fundamental decision making about why they should invest it, and that in essence what creates a bubble or so forth. And you get a lot of those little micro bubbles within inside them. And so, now you have a bunch of uneducated capital rushing to get into the club to, suddenly find out once you get inside that literally it was just a line out the door and there's no one actually inside. That dynamic happens. Now, there are another group of companies that don't do that, play that game, that may be completely off the radar.
Now, before we continue, a quick word about an incredible resource for startup founders. This episode of the Ignite podcast is brought to you by Build, spelled BYLDD. So what is Build? Well, they specialize with early stage startups, especially non-technical founders and teams, helping you build and launch scalable revenue generating software fast and affordably. Most startups can't afford to drop 100K on some big design engineering agency. Freelancers are risky, inconsistent, and full of project management headaches. For 10K in about a month, they can turn your validated idea into a real market-ready product. It's built for scalability. Past clients have been accepted into YC, Y Combinator, very impressive, received backing from Google, and raised multi-million-dollar rounds. And there's an exclusive offer for Ignite listeners. Get a free UI, UX design sprint that's 3 to 4 weeks, a deep dive into your product experience, delivered completely free. This is normally a $10,000 plus service. So head to byld.com, connect with Ayush and team, mention the Ignite podcast. Let's get back to it.
Coming in there, and they will get a small group of people that will come in and see something that's very interesting and then shop it around to their friends. And like, they essentially never come on the market. So, there is, I want to say, trend following drives up value in the business. More people come in, supply demand.
That's a tulip craze, basically. I need the special tulip.
If that trend following and so forth is not predicated on rational, I want to say, assessment of the business, if it's not educated people encoding interest in the market price, then you're probably getting an inflated price. Now, that's still probably not, for a lot of things, a bad situation in the venture space, but certainly there are a small percentage there that is inversely correlated to success within inside the market. The other ones where it is, what we'll call perceivably hot deals and everyone figured out was hot like after the fact or so forth, those ones are good. And I often find like the founders that fall into the latter good category, they don't come at it with the mindset that I'm going to try to milk the market to get the highest value. They are coming at it with the sense that I've got a business that I want to build. I want to spend as little time as I need to fundraising, but I also want to maximize, the talent and individuals that I have at my disposal coming on here. They understand the investor and founder relationship. It is a relationship. Both parties wanting, should be fair to each other because it's going to last a long time. Your investors, at the end of the day, when things, don't work out, you're going to find out who the really good investors are that will just, go to no ends to help you get over that next hurdle, versus, honestly, in most cases, a losing company is in no one's interest to really extend. Like, you're going to focus on what's the biggest driver and value to the portfolio. But, when it's based on fairness and good relationships, like long-term relationships, like everyone gets value out of that. And I think that's a pretty, that is like, a differentiating factor. It's not so much whether the company is hot or not, it's what is predicating that heat.
Well said. I'm learning so much. We didn't talk about the origin story of the YC fund, focus funds that you have now. And like, how did you end up investing in YC? What's that kind of origin story look like?
I don't know how actually interesting that is. I think to some perspective, and like, what came off when I was doing the first fund, we'd just come off Pebble. And, all the while that ever since I've been in YC, like, there's always been in the back of my mind about, I have such a front row seat to this group of people. When you're in it, you just feel how differentiating it is from the other pools of startups that, prior to YC, that you're just surrounded with. The idea of raising a fund and basically providing access to that, like, that always is in the back of my mind. It seemed, given my finance background, simply the next logical step. I think what is interesting is the first fund was very much an experiment. It came out of there like, I remember it was like 2 weeks before demo day, and I was like, "Hey, Eric, you want to raise a demo day fund?" Like, that was about the extent of it. And
Wow. What year was this?
This is summer 2017. It's one of those things where it's like, cool, let's do it. And then you've actually got to, execute on it. And, I went out to my London Business School crew. They were provided, a bulk of the capital on it. And it was really structured in the sense of, hey, I'm thinking of doing this project. Is anyone, interested? Like, I honestly have always treated the fund a bit like doing product market research for a consumer product. Like, you have a hypothesis, you test the hypothesis. It was a little compressed this time around, but, we ended up getting, a degree of interest. Like, it wasn't a ton, but then just like, you're just like, hey, cool. Like, this is, enough to get the car started. And, got that closed. Alumni demo day came around, and it was like, okay, cool. My thesis was, we got to hit 20 some companies this batch. Like, let's just go out, close it, and build it. And with the time, writing smaller checks just wasn't really the flavor that it is today. And, got it done. And then, it's kind of like, okay, that project is essentially baked. And that really was the genesis. And it wasn't really till a couple of years, later. You're providing investor updates and other things along the way and paying attention. But it wasn't really, a couple of years later when, like, suddenly benchmarks start coming out and you kind of realize what the actual, quality of that portfolio is regards to, the wider market and so forth. And, we were well in the upper decile of performance for that particular vintage. So then I did another few years, in between that, to like, okay, like the thesis, the other one we scaled up bigger, more companies, more other stuff. But like, the thesis really was playing out, as expected. And so that's what really kind of, then, honestly, it is a fatiguing process in one thing. Like, it was not like this was meant to be, a profession or so forth. And it wasn't really till, I got roped back into, I think it was winter 23, that, it was like a progressive campaign to get me back into the AngelList Demo Day programs and so forth. And I, came at it with like, okay, if I am going to do this, like, now I really am going to focus on, I think it was the right place and time. So, had a lot of, the learnings, the track records and so forth from the prior funds, the playbooks about how to run this. And, now it's, we're in a very, very different category where it really is just, we optimize our process. It's very, very systematic. We're now investing a lot more into additive value and so forth. And, not trying to, again, as always, be the traditional venture fund or do things like anyone else does. It's like, we're going to look at what is, what needs fixing, where there's an opportunity for improvement or growth, and come up with a creative, solution to do that. And, I think it's a very, very different game now. And, while it is an exceptional amount of work, to pull it off, like we've gotten over a bit of a hump. Like I now have a fairly decent, team behind what it is we do. And, you kind of now see the bigger peak to go off of. You see where you drive value, where the opportunities are. And, that is, motivating. I mean, I often talk about this and with regard to the founders, like, this is my startup. And, we've, I think, gotten into a position that, it's working quite well. Like the business is a business now. And that was, a pretty nice hump to get over. So yeah, accidentally stumbled into venture, if you want the short version.
Yeah, I think most of us do. Plans. I guess nowadays young people are trying to plan to get into venture, and I tell them like just go do a startup, go build something. Don't try to get into venture too young. Go build something, struggle through shipping things and failing and trying to sell things, and then do venture later. What do you think about that?
Yeah. I mean, I agree with you completely. I think it is. I mean, I'd be curious to actually have a little, study around to find out, those venture capitalists that did not come through that route and really just see, how
maybe there's some biases that these founders and operators have that, if you just do a pure career of investing that you just don't have, you can be more objective or something.
Yeah. I mean, I think, you cannot intimately understand the founder, the trajectory, the dynamics of, a company without really having been through it yourself. I mean, you clearly get more respect and have more ability to communicate with someone when they are looking at you as someone that can provide advice, and like actual advice, of having been there and done that. Like that's a very different dynamic than being, a check or so forth. I do think it's also a business of connections. Like, it's the private of the private markets. So much happens through channels that are just not public, and without a relationship, like you're just not going to find out that that opportunity exists. I'm certain we cannot do what it is we do without, the 15 years I've had in, the space building the connection. I mean, if like for me, it's like, YC is the area that I own. It felt like, we were well into the whole YC cycle and stuff when I went through, but I realized like, we were one of the, we were the nascent batch when they're still writing 27K, checks, basically barely enough to support your team in San Francisco for 3 months, and you're still eating Paul Graham's chili and other, sitting on sawhorse benches and so forth. And when YC itself had not like actually, proven. I mean, I think I do remember, like second or third batch dinner, like we suddenly got steak because Heroku had gotten acquired by Salesforce. It was like the first material exit for, YC, and they decided to treat everyone to a steak dinner. That is kind of my formative and entry point into YC. And now if I think about it, like, I mean, the number of people from my batches that are, VC, I mean, Gary was still the photographer, right, at that point. But like, this entire, community of people where we were all figuring out together, now are, titans in the, in the industry, being Sam Altman or, whoever else, out there, right, Alexis and other things. Like this is, we've all, the
YC mafia is real.
Yeah. I mean, it's like, that is your network and base to work off of. And it's, clearly has an advantage, which if you're coming in from, the outside, like, sure, you've got access to capital in a way that most, I want to say founders turn VCs wouldn't have, as direct. The venture as, a business, the money is the commodity. Part that's not the commodity is the companies and businesses. And I think, like as I, talk to LPs and so forth that might have, a traditional kind of view and experience, they are often presume that, they own the checkbook. They have the, I want to say, they are the person in position and power, which for 98% of the deals out there, like that is the dynamic. But that 2%, out there, completely shifts. There is, supply and demand curve is, the polar opposite. And if you're the company that's got it, you get to pick and choose. And if you want to be able to deploy capital in that space, you need access, you need the relationships and so forth. And so, that's a very, not to say you can't build that from coming in and making that your business and objective to do. The best founders are builders, and you're going to get the respect from someone that truly understands the building part of it. So it's going to be an advantage.
How do you think about fund mechanics? Because you've been doing these demo day funds for 8 years now. Have you ever thought about just doing a typical 3-year fund, so you only have to fundraise every 3 years? Or how do you think about that?
Yeah, I've certainly thought about it. We purposely do the demo day model raising, regularly, because to some degree, I view what we do is, we're almost more of a financial product than a venture firm. We function, exist, and provide everything like a venture firm. But, what we're selling is, access in a diversified portfolio for a specific YC batch. And, by in essence having to sing for our supper every batch, it keeps us honest. It keeps us, agile. We don't get to rest on our laurels of the last batch. It's like, you're back again there. And I think for us, as when you're in a situation of growth, that really is you want to force yourself to be hungry. And so there's a very conscious reason for that. It's also in the same time, if we were to raise a larger fund, we'd have to step back probably for a period of time. I can't put that degree of capital together, in the time frame we do. There's a period of needing to make that transition. But yeah, I ultimately what I see, where we go is the fundraising stuff does eventually become a bit, operationalized. And, there's other things you think about, you raise a 3-year fund, now all of a sudden you've got to actually think about capital planning. There's a whole nother degree of complexity and so forth that come in, and, being able to kind of tailor everything we do to the here and now is a lot of, it has its advantages over I always know how much I'm going to be able to spend. And, that's it. If we find a company that, is great and we like to get in there, but we're out of capital, we either got to raise more capital or, just deal with what we, with the pie we baked. So, I do think for follow on and so forth, we started last year doing more SPVs for stuff. And it's not, it's not taken over kind of as the main business because, right now with the changeover to 4 batches a year, there's a lot of just operational changes and baseline stuff that we keep needing to get, in place to be able to do what we do quarterly. But there is a healthy appetite for LPs for, follow on deals. And, there's something nice again about doing SPVs over having a larger fund where it's you've really aligned yourself with the founder. You've got to pick what company you're going to spend the time with. We push out what I'd say, we're closer to an investment bank. We push out, detailed prospectuses with analysis about why we believe this is a good company, a good investment on here. We don't trade on hype or so forth because that's the brand I want to build over a period of time. But, that means is if, we put together something and the market doesn't like it, well, it's time we spent and, that's, we got to have to live with it. And so,
what's your AUM at this point with 500 startups? What's your AUM, your assets under management?
What are we? I think collectively we're 40, 50, something like that. Wow. I haven't, I remember someone talking about it. They're like, oh, that's a strange way to build a venture fund. We do, I want to say, 3 to 5, is our target each batch. And depending, it's changed a little bit with the quarterly model, but every year we grow a little bit, and there's a cyclical nature across the summer. Raising from European LPs in the summer is the worst time to raise for LPs. It's a slog, but we make it happen. And running the SPVs, there's something I like a lot about that. I do think at some point in time raising a broader opportunity fund makes sense.
Right.
There are, not these days, but traditionally there's deals that would just move too fast to be able to syndicate them.
Right.
the other downside is being a YC Demo Day focused fund, like we get a lot of very high quality deal flow that comes organically. Now I just have to pass on that, which is good and bad.
Yeah, you get some YC founders on their second or third startup at this point, and
Yeah.
they're great founders. Yeah.
Like, I mean, I think, there's truly, a lot being left on the table, but, for an early fund at our stage, we don't want to spread ourselves too thin. Like, when demo day is building a certain amount of portfolio is a very easy, in some perspective, easy way to construct your portfolio. If you are moving outside of that and now taking in fresh deal flow, particularly, if it's not pure seed stage and there are in fact cash flows associated with it and market dynamics and so forth, there's substantially more work, that goes on, particularly then if you step outside of YC, like I just cannot trade upon, the known 20-year track record that YC has. So your diligence, your other stuff around there, they're orders of magnitude more time. And that now means orders of magnitude time, resources, and other stuff for the fund. So it's a very different leap. And I mean, everyone wants to go bigger. It's always kind of the natural thing here. But I mean, I found if you understand where you're at any given point in time and are comfortable with that, you've actually got something really good going that's working well. And rather than trying to juice growth, you let the organic nature of growth pull you, you're almost uniformly in a better position. Like, scaling up, whether it's taking on capital to grow your startup or whether it's, taking on a big fundraise, there's a whole, group of risks and so forth, that obligations that come with that as a result. And if you just are patient and let the natural growth rate go, it may take you a little longer to get there. But at the end of the day, the rate of growth, the rate of return is going to dominate. And you'll be in a much better position, like the likelihood of screwing something up by going big is far greater than, I want to say the likelihood of getting it right.
Yeah. Small is beautiful in venture. You saw the Carta data recently published. The top decile funds are disproportionately, sub 10 million. You just have.
I mean, completely flip on this. I mean, simply from the, fund size, I mean, literally in any situation, it's like as you grow, your opportunity pool for, the level of returns, shrinks. I mean, that's the family office problem is it's like, look, I'm not trying to get an amazing return here. I just have, 80 million. I need, a year to park somewhere. And, if I can get 2%, like a large, if you like, the deca-billion-dollar funds or so forth, like if I can get 2% my cost of capital, like I've done good. It's just, there is hard for, most to believe challenges that would, like there is too much money. Like it, you just can't, you can't make it productive in the way that, isn't the same reason, as funds are not funds, as, companies become public and so forth. Like, why did their growth rate just stagnate? The opportunity just isn't there, like it was when you were, smaller. So from, an LP perspective, like you want large scale growth opportunities, early stage market is a primary place to go in there as long as you can diversify to make sure that you have a portfolio construction that maps to the return profile.
What's the story with your profile photo? It looks like you're like in an 80s rock band.
Yeah, it's a Halloween costume. I mean, the requisite joke is it keeps the recruiters away. I mean, give you a little, it's not purely, I mean, it, exudes, a little bit of my background on here, but, I don't know if you've ever seen, I mean, you can just go there, go find like a, UBS Swiss banker LinkedIn profile. They're going to have, white shirt, red tie, blue jacket. I mean, it's a entirely forgettable, profile picture. And, who are we marketing to? Who matters in this equation? It's the startup founder.
Primarily, yeah.
And, that is the product which we then, sell. You having personality is not a bad thing. Like, it's very, I should put it, if you create a reaction, you have engagement or so forth, particularly in a, beneficial, funny sort of way,
Yeah.
you become memorable, you become relatable, you stuff. So, it's not, while it is organic and authentic, it's around there, like, it's there in a, somewhat calculated sort of way. And then, I mean, I do also treat it like, as a filter on the LP side of things. Like, look, if you're not going, if you're going to judge a book by a cover or so forth, like, that's fine. Like,
Probably
I
not a
don't
fit for you. Yeah.
Yeah.
I
So,
should put my my Dwight Schrute costume up there.
yeah, I will say I get a tremendous amount of flack from everyone I work with about that, but I think it's
I
just
think it's great. It's memorable because I remember the first time I saw it, I was like, "That's cool! Like that's clearly like a costume, and it's just shows pizzazz and character, and it's memorable." You
yeah.
know?
So I do think I'm probably due for an update at some point in time. It's that was back in the Pebble days, but
Yeah. My problem is
well,
my profile photo is like 10 years old, and I'm now in my mid 40s, and it's from my mid
yeah.
30s, and
Well, I
I'm
think we all have those, and then uh-oh.
it's like look at myself in the mirror now. I'm
You
like,
know,
"Oh, who's the
yeah,
old
yeah,
guy?" You know?
you could get an agent to appropriately age your profile photo. Like maybe that really should be a little
There's an
side
AI
service.
startup right there. Yeah,
Just every year keep the
notch it up
same
a bit.
just there, but make it age
A good
appropriate.
idea. So I'd be remiss if I didn't ask you how you evaluate YC companies. I mean, you've done almost 500 of these. I mean, like they're all amazing teams. Obviously, they made it
Yeah,
into YC. Like, what percentage of the batch are you targeting? What's your check size? And like,
yeah.
how do you make
About
these
25
decisions?
30%. 30% of the batch. I mean, our check size will vary from batch to batch, but generally the mechanism that we do going into it is, we have a roughly target, company size could be, 50 and upwards of 80 companies in a particular batch,
Wow, that many.
are raising and pretty much close right as we shift over. What will happen is we'll set a target check size based on that. And so our total amount of capital or total number of company counts will, once we fix the check size, largely depend on how much money we raise. And there's always kind of about a week shift over in that process. Actually the process, I mean, there's the decision making process and so forth. Largely you've got like, what leading up to demo day, there are a couple, kind of like waves of startups that basically come onto the market. And so, we're building a portfolio. So there's one element of, again, I want to make sure we get exposure to, what is out there. There's an interesting dynamic also with YC. So some companies are literally just coming, you're not even aware of them until you've closed deals on a variety of other companies. Like, so it's a system where everything is changing kind of as you go through, and it's a very high time pressure environment. So it's a lot of different things are engineered to optimize inside that environment rather than simply, yes, you could maybe go through and analyze and figure out what the optimal companies are in here, but you're not then going to be able to invest in 70% of those companies because those opportunities won't miss, or you won't even know that those opportunities exist. So, we have a lot of early intel coming in here. The team too, this is where a lot comes in here. Like, we build our target portfolios out here. It's understanding what the makeup of the, companies are, what we like, as much kind of information as we can get at that given point in time to really say, like, this is what we'd like the portfolio to be. And then we can adjust it. And then you go into triaging companies you do have a little bit of a sense of what are going to be the hot, fast moving companies on there. So you want to make sure you get them, T-3 or whatever when, they are going through. I mean, it's, variety of reasons now, like we are often companies will actively seek us out as being like the first investor that we talk to. So that has been a lot of engineered process. But so once you kind of have this, then you're going into actually talking with the founders, and going in every batch has a bit of flavor to it. You kind of understand the pace. So like there's a little bit of a learning curve of what are caps going to be this batch, what's considered high, what's considered low. That's ebbed with the amount of capital coming in and out. I mean, you also, from my perspective, like depending on who their partner is and so forth, like I know
Oh,
what
how they're going to
style.
negotiate and how they're going to advise the startup. Yeah.
But, like at the end of the day, there's very, there are basically no terms that need to be negotiated in there. Like they're going to have a cap, whether they get it or not, the market is going to confirm. And so like, I have no problem committing early. And if, it's a $25 million cap and they ended up doing a 20, like they'll revise. I mean, like uniformly the terms get revised down. So there's really no downside to that. And then, going into that meeting, I've done, we have a lot of stuff. There may be specific, numerical things like, what is their actual revenue and so forth. Like I won't have going into the meeting, but I know what that company's doing. I know by proxy being part of the YC ecosystem. I know if they've tried something, gone through a pivot, what the evolution of it is.
You can tell by the deck, basically, does it have revenue or does it have like a timeline?
Yeah. So, so when I'm actually going into, the calls, like, we are largely, like it's high intent. Like I try not to waste founders' time.
Right.
And so
one and done, 30-minute meeting. Yeah.
Yeah. I mean, we're looking at, just getting to know someone, filling in the blanks that we don't do. Rarely do you, come across and actually jump in a meeting where it's not like your assumptions and stuff were not, right. Decisions from, our side are really based on, is this going to fill this slot in the portfolio? Am I going to be able to allocate capital elsewhere? Or if I defer, is there an opportunity, cost associated with that? Because there's a lot of different ways, to build a portfolio, particularly in recent batches, like, you've got companies that are doing hundreds, millions of ARR, coming through, and then you've also got companies that haven't really even launched yet. Right. And I think there's a tendency, rightly so, if you're doing smart funds, to go to the companies that, clearly we've got, traction or so forth. But, I'd rather, like, that isn't necessarily the predictor of, ultimate success. I mean, you talk about, my journey with YC. I mean, there's a period of time that everyone thought Earbits was the hottest company. Every founder thought Earbits was the hottest company in the W11 batch because we had a dude with dreadlocks that, was our CEO, and we were all musician stuff. And so, like, we're cool and had stage presence. But, clearly that's not the case, and then Pebble came to the front. And, if I look at it, it's, 7 years post that, suddenly the indiction, hit it with, GOAT after, 12, 15 pivots of, so forth, now they're the company from the batch to truly, take off. When, you just see, that time you see all the cycling and stuff, like, you don't know. Late bloomers are just as good as, early.
Right. That's what the data shows is, the valuation's predictive of the Series A, but it's not predictive of like 100x.
Yeah. So, you always have to, take into mind that, like, you're working in a, scenario where you have a very small piece of, information. So when I'm looking at, like, when I'm actually looking at a company and so forth, it's not so much any given market or so forth. Like, it's the founders, to how they think about stuff, how they're approaching things, how, where that fits in the market. If I'm looking at, a biotech company versus, there's a whole, like, tiers of AI companies or space companies. So we're like, every one of those has its own, dynamic, and so, like, what LOIs are that are considered good versus, like, okay, this, like, there's just a lot of variables that you're now packing together to give a little, kind of a thesis on the individual company. But because we're doing so many companies aren't here, like, our, and the dynamics of us getting it wrong, like we just don't have a really material downside. If I make a bad bet, there's always 2 or 3 companies that I, like, potentially regret, saying yes to inside a batch. Does that matter? It doesn't. And it also doesn't mean that they're actually necessarily not going to return, for the business. And, so there's just like, it's a lot of different things, but, in the micro level, I'm combining, a variety of things. And then again, it varies. Like if I'm looking at like therapeutics companies or so forth, I'm talking to seasoned medical professionals to, not grade the founders, not grade stuff. It's like, these guys are doing X, is this a medical problem that's going to be solved? Or is this, in the hospital administration, like, is this really something that from your knowledge perspective, like needs working on? Or what is the impact of doing that? And so, you can, someone in that position kind of clearly say like, look, yeah, this just doesn't make sense. Like the research here, like, it's not good versus like, yeah, actually, like, these are particularly sort of things, that like really would have, if solved, have a very material impact in a variety of space. And so, now you've checked off a certain, box of relevancy to doing, not to say that the other people can't, they're like totally different category than the B2B AI SaaS company where, look, what we're doing today could very well be eclipsed by another company tomorrow. Your path to success is your ability to either keep pushing faster than everyone else or keep, discovering that next opportunity. Completely different style of founders, but you can assess each of them on their own merits, and they're all going to contribute in a particular sort of way.
Well said. And what I typically tell people is something along the lines of like, every startup's a beautiful snowflake, and I'm going to analyze that beautiful crystalline structure uniquely to that time and place of that startup. And there is no hard and fast rules of evaluating startups.
Time and place is also a big important factor. Like, you are in a situation that things are moving so quickly, you really need to know what is timely right now.
Well, I could have talked to you for another couple hours. I got through like half my show notes. That's how I know the conversation was amazing. I'm sure people are going to get a ton of knowledge from this. I sure did. Where can folks find you online?
I guess you can probably find me in LinkedIn or accessfund.vc if you want to drop me a note in our inbox. But yeah,
be a little check in the Demo Day Fund.
Yeah. Yes. So I mean, we're always raising. So
that's right.
Every quarter, you want access to great YC companies, by all means, hit us up. So
thank you so much. I really enjoyed it.
All right. Thank you, Brian. Pleasure chatting.